Now let's practice the intangible asset simulation. That is the comprehensive simulation, including the franchise accounting. Right, we have a long way to go, creating the balance sheet and income statement, including all these four parts of the transactions. Okay, let's get started. On January 1st, 2004, A Corporation signed an agreement to operate as a franchise of B Corporation for an initial franchise fee of $75,000. Okay, the A Corporation is the franchisee company, and the B Corporation is the franchisor. So the A Corporation will pay the initial franchise fees and ongoing fee as well. Of this amount, $15,000 was paid when the agreement was signed, and the balance is payable in 4 annual payments of $15,000 each at the end of 2004, 2005, and 2006 and 7. So in total, the 5 payments, so $15,000 times 5, which is the $75,000, the franchise fee. The agreement provides that the down payment is not refundable and no future services are required of the franchisor. The present value at January 1st, 2004 of the 4 annual payments discount, this 4 annual payment except for the initial payment of $15,000 paid on January 1st is now discounted at 14%. So, very kind. We have given this $43,700 for this 4 times the future payment. Present value of this 4 times the payments. The $60,000 in the future should be discounted by 14%. And the agreement also provides that 5% of the revenue from the franchise must be paid to the franchisor annually. Okay, that is the ongoing fee. So if A Corporation, okay, we have information. A Corporation revenue from the franchise for 2004 was $950,000. So out of this the revenue, and 5% should be paid as ongoing fee to B Corporation franchisor. And A Corporation estimated the useful life of the franchise to be 10 years. That means that the franchise asset, the right to receive this franchise, the benefit, should be amortized along with the lifetime of this franchisees the benefit by 10 years. Okay, so let's just start. First, the easy one, the cash paid. The A Corporation paid cash how much? Right, the $15,000. Okay, I'm going to just put $15,000. And then initial fee payable. Initial fee payable in the future, except for the initial payment when they make the contract, $15,000, the $60,000, right? The $60,000, 4 times annual payments for $15,000 each at the end of 2004, 5, 6, and 7. So total $60,000 should be discounted by the 14%. And the present value of this, the $15,000, the annual payment for 4 years is $34,700. That is right. That is the payable. So we put initial payable, initial fee payable. Initial fee payable. How much is that? Right, $34,700. And then here, that is the asset, the franchisee's asset to receive this, the benefit, the right to receive this franchise. Right? So we put franchise asset exactly the present value of this franchise asset, 57,800. Okay. Now the second, initial fee and ongoing fee payment. Let's assume that the company paid every end of year, like the question asked, if this payment incurred every beginning of year, we have a little bit complicated procedure, all the payable recognition. But this case is the relatively simple. Here, we have to pay. We have to pay $15,000 out of $15,000. This $15,000 annual fee is comprised of initial fee payable, which is part of the principal, and the interest, because that $34,700 is payable, that produces interest. So that interest expense should be recognized. How do you get it? 34,700 times, right, 40%. 14%. So interest expense should be recognized when they pay this $15,000, and then here initial. Let me just look this. Initial fee payable should be reduced. How much? By $15,000? No, this $15,000 is including already this $1,618 interest expense. So the $15,000 payment minus, right? That is the annuity rule. So that is total is $15,000. Is that correct? And then how much does the company pay? How much does the company pay? Right, the ongoing as well. Ongoing, the fee expense. Now, ongoing fee expense is ongoing fee expense. How do you calculate? 950,000 times 5%. That shows the contract. In the contract, the agreement also provide 5% of revenue. So 75,500. That is the payment to the franchisor, company B. So cash amount should be paid is the sum of this. So 62,500. That is the cash amount. Again, 47,500 ongoing fee plus $15,000 the initial fee payable. Okay. So once the company paid this total amount, $15,000. Now, out of $43,700, the present value of the $60,000, the total 4 times of the payment should be reduced by only $8,882, which is the principal part out of this, right? Out of this. Because that $15,000 includes this interest expense as well. Now, let's do the amortization of the franchisee asset. Amortization of the franchise asset. Why? Because this franchise asset should be amortized when the company use this benefit, right? Use this benefit. Then let's do this work together. How do we recognize? Right. Amortization expense of this franchise fees divided by how long years is the useful life of this franchise for the company. Right. 10 years. So for 5,870 should be allocated amortization expense and accumulated amortization as well. So accumulated amortization, the same. Now let's report this transaction into the balance sheet and income statement. Franchise asset initially here we go, franchise asset. And then cash paid. Let's assume the company has had the $500,000 in cash by issuing the common stock. Minus 15,000, right? Then initial fee payable. Initial fee payable, there we go. 43,700. So we matched out. And then here, the interest expense we should record, here we go, in the other expense and loss. Interest expense, that it should be here, and the net income and loss, the total amount on the income statement for all the transaction, income statement account, it should be related to the retained earning. So we have also ongoing fee expense. Ongoing fee expense 47,500. Ongoing fee, initial fee payable first. That is the liability. We haven't. We recorded already. Sorry. Here, I'm sorry, that was wrong. Let's put the initial fee here. Then initial fee payable reduced by the principal of the first year. And then ongoing fee expense, here we go. That is now minus 47,500. And then finally, the cash out in total 62,500. So we matched out between total asset and total liability and equity. The last transaction for the adjustment for straight line amortization of a franchise asset, amortization expense, we put, here we go, amortization expense on the income statement. Then accumulated amortization expense on the balance sheet. So we allocate the cost that then we got the franchise, the book value, net book value, 52,800. So we balanced out. Okay. So let's stop here for the franchise accounting for the perspective of franchisee. And then we'll continue the rest of the transaction in the next video clip. Bye-bye.